Hi, welcome to Dig Into China. I'm Dong Xiang. Recently, Xi Jinping has been busy with meetings after completing the third plenary sessions of the 20th Central Committee, which focused on his rather primitive approach to economic education. He quickly held another Politburo meeting to analyze the current economic situation. While the third plenary session of the 20th Central Committee set the major directions for the upcoming years, the mid-year Politburo meeting establishes the approach for economic work in the second half of the year. To put it plainly, the main focus of the Politburo meeting is how to boost China's GDP growth rate to 5% for the second half of the year. So in this video, we'll thoroughly discuss Xi Jinping's plans for achieving this GDP target. In the latter part of the program, we'll delve into some gossip, especially the story of Fang Xinghai, the Vice Chairman of the China Securities Regulatory Commission, being sacrificed by Xi Jinping. If sacrificing a vice chairman can boost the stock market for a day, what would happen if a dictator was sacrificed? Alright, let's get back to the main topic and discuss the Politburo meeting on July 30th. We'll do a bit of a role play. Even though the meeting was closed to the public, I'll use my imagination to simulate what Xi Jinping might have said. Here is a likely rendition of his speech. Listen up. The current situation is quite challenging for us. Domestically, we've already squeezed nearly all potential from our consumers, leaving us with debt and no cash. And we can't rely on domestic demand anymore. Internationally, regardless of who takes charge in the US, they will definitely impose more tariffs on us, threatening our external demand. As you all know, without the assistance of our colleagues at the Statistics Bureau, our GDP for the first half of the year would have been in serious trouble. With July now behind us, what are our plans for the second half of the year? Where are we going to find that GDP growth? At this point, Vice Premier He Lifeng spoke up, saying, "Your Majesty, don't worry. I have a great solution. Achieving GDP growth is simply a matter of spending money. Spending enough and you can reach any target you set. Remember, we plan to issue 1 trillion yuan in special government bonds at the start of the year. We've already allocated 300 billion yuan for upgrading equipment. So we still have 700 billion yuan remaining. Let's ensure we spend that 700 billion yuan in the second half of the year and we don't have to worry about not meeting our GDP growth target." Then she asked, "So where should we spend this 700 billion yuan?" Comrade He Lifeng replied, "Of course, we should invest in new forms of productive forces as you have suggested, Your Majesty. However, there is a strategy to this spending. My proposal is to cultivate more companies like Huawei and BYD. While these may seem like private enterprises on the surface, we can use the pretense of supporting private business to placate public opinion and avoid the backlash against our spending. In reality, these companies can be controlled behind the scene, much like state-owned enterprises, and will follow our directives without question. So, we should invest the remaining 700 billion yuan in developing a few high-tech companies. We'll bring in firms specializing in chips, IT, new energy, and AI. And Your Majesty can select which ones to support according to your preference." Then Xi Jinping asked, "Is 700 billion yuan sufficient? Have you done the calculations?" Comrade He Lifeng responded, "We have more than just this 700 billion yuan. In the first 7 months of the year, less than half of the local special bonds were issued. We still have about 3 trillion yuan left to be issued in the second half of the year. We don't need to worry about them not contributing to GDP growth." Xi Jinping's expression darkened as he said, "These unreliable local officials and the troublemakers have accumulated massive debts in recent years. Will this money even cover their bank interests? Are you certain they have any funds left for investment?" Comrade He Lifeng replied, "Your Majesty, don't worry. Since the banks are under our control, I have arranged for them not to collect interest from these local officials this year. This will allow them to use all their funds to boost the GDP and focus on meeting this year's targets first." Finally, Xi Jinping nodded approvingly and said, Learn from He Lifeng. He's always thinking ahead and getting things done. You all just come to me asking for money. From now on, if you want funding, you'd better deliver GDP in return, or I'll make an example of you. The meeting is adjourned. Putting entertainment aside, the core issue of this Politburo meeting was how to spend fiscal funds in the second half of the year. As we know, China's economy heavily relies on government investment, while the private sector remains largely inactive. If Xi Jinping insists on achieving a 5% GDP growth rate this year, it will require a major draw on fiscal resources for the rest of the year. However, given Xi Jinping's current preferences, he is no longer focused on projects like high-speed railways or airports. Instead, his attention has shifted to new forms of productive forces. This means that industries such as AI, new energy, new materials, and semiconductors are likely to benefit. The plan is to support a few more companies similar to Huawei and BYD. While these companies may appear as private enterprises, they will essentially operate like state-owned enterprises, with substantial fiscal and credit resources directed toward them. The aim is to use these companies to compete internationally and place a strategic bet on the country's future. We have seen a similar pattern in the electric vehicle sector before. This time, however, at the Politburo meeting, Xi Jinping took a small but notable step forward by introducing an anti-involution slogan, indicating that he's recognized the setbacks in the electric vehicle industry. Despite substantial fiscal subsidies, the international market remains elusive, while domestic competition has become so intense that it's undermining the sector. But announcing an anti-involution stance won't necessarily resolve the issue. Many participants are primarily interested in obtaining subsidies. Who wouldn't want a share of such a large financial benefit? While they might struggle to compete fairly in global markets against foreign competitors, they are quite skilled at navigating domestic rivalries. Ultimately, the problem lies in the fact that China's market isn't a truly open and transparent economic system, and the competition between companies doesn't genuinely reflect merit-based survival. Alright, having covered the Politburo meeting, let's now turn to the recent event where a Vice Chairman of the China Securities Regulatory Commission was sacrificed. On July 30th, Fang Xinghai, the Vice Chairman of the China Securities Regulatory Commission, was dismissed. Officially, the reason given was reaching retirement age, but it's widely understood that this was a move by Xi Jinping to use him as a scapegoat. The day Fang Xinghai's departure was announced, A-share investors expressed their relief and vented their anger. They see him as the father of short selling in the A-share market, blaming him for permitting quantitative funds and securities lending, which they believe led to widespread exploitation of investors. Despite being taken advantage for years, many A-share investors remain largely unaware and confused about the situation. On July 31st, amidst this widespread sense of vengeance, the A-share index saw a significant increase. However, don't mistake this as an attempt to justify Fang Xinghai. I have no sympathy for any official within the communist system, especially those in economic roles. That said, it's important to recognize that this issue is systemic rather than just a problem with one individual. Let's examine Fang Xinghai's background. He entered Tsinghua University in 1981, went on a government-sponsored study abroad program to the United States, and earned a PhD in economics from Stanford. He was then recruited by Zhou Xiaochuan, who was the chairman of the central bank at the time, and returned to China, quickly rising to a high-level position at the construction bank. As I have pointed out before, China's regulatory agencies typically prefer individuals with backgrounds in state-owned banks. So, Fang Xinghai was firmly entrenched in the financial establishment. Unlike the current chairman of the China Securities Regulatory Commission, Wu Qing, Fang Xinghai was part of the financial elite. This group has two distinct traits. First, they are often seen as pro-Western. They have generally received Western higher education and are strong proponents of reform and opening up, advocating for the adoption of American financial system. Second, they operate within exclusive, serving the interests of their own groups and benefiting from the reform era's advantages. Most importantly, they consider themselves elite and look down on those they perceive as less sophisticated. This disdain for Xi Jinping's traditional views has made them targets as they vie for influence and benefits, which ultimately makes them vulnerable to being removed by him. Returning to the Asia markets, as I've said before, the reason it remains stuck around the 3,000 point level isn't due to short selling mechanism or quantitative funds. In the US, short selling occurs every day, yet the market has continued to rise over the years. The real issue with the Asia market is that it was set up to allow state-owned enterprises to exploit the retail investors. Fair trading is impossible here because the Chinese Security Regulatory Commission, the national team, the numerous listed state-owned and central enterprises are all under communist control. How can individual investors expect to profit in such a rigged system? So if an investor who has been struggling in the Asia market for years is celebrating the removal of a vice chairman, it's clear that their suffering is a consequence of their own misunderstanding. Their lack of awareness matches the difficulties they endure. Here is the situation. There are 4 vice chairmen at the China Security Regulatory Commission. If each sacrifice leads to a one-day surge in the Asia market, then after 4 days, there won't be much left to boost. So, what will support the market moving forward? When will the Asia market become a truly healthy stock market? Sacrificing a few regulatory officials won't fix the underlying issues. It seems that a more fundamental change, possibly involving even Xi Jinping, might be necessary. To summarize, the latest PMI data for July reveals that the Chinese economy is starting the second half of the year on a weak note. Ideally, with the prospect of severe tariffs if Trump is re-elected, US importers would be expected to stock up in advance. However, the new export orders index, which indicates external demand, is not showing any signs of increase. Instead, it continues to shrink. In reality, I've been dubious about China's export data for this year. For instance, the PMI index for new export orders has been consistently below 50%, showing that not only are export orders decreasing, but orders being received are also being cancelled each month. Given this, it's questionable how exports could have grown significantly in the first half of the year. There must be some exaggeration or distortion in those figures. With no significant improvement in external demand and the domestic demand remains weak, the new orders index for domestic manufacturing remains below 50%, and employment is declining. This indicates a typical contraction in business scale. Thus, to increase GDP in the second half of the year, China will have to depend on government spending to artificially boost the numbers. Consequently, the recent Politburo meeting focused on how to allocate funds and inflate GDP figures, matters that have little impact on the average citizen. Regarding the Asia market, those who regularly follow my insights know better than to be deceived by these political sacrifices. Don't let the dismissal of a vice chairman of the China Security Regulatory Commission mislead you. It's time to act quickly and get out. The national team won't be able to push bank stocks higher to bring the index back to 3,000 points. They are gearing up to cut their losses. Run, Forrest, run. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.